Is 2026 about to unleash the biggest market crash in decades, or is it the final leg of an exponential bull run? The signals are everywhere. The Buffett Indicator is near historic highs, interest rates are choking the economy, housing is starting to flash red across the globe, and crypto's 4-year cycle points to turbulence ahead. On the surface, it all looks like disaster, but if you know how to position yourself, it might be the single best opportunity of our lifetime. What's more, Andrew Tate has gone viral with his warning that real estate is finished. He says young people aren't signing up for 30-year mortgages anymore, they're putting their savings into Bitcoin instead. In this video, we're going to break down the red flags pointing to a crash in 2026, how Warren Buffett is preparing to win no matter what happens, and why Andrew Tate believes Bitcoin will be the biggest winner of all. By the end, you'll see why the great crash of 2026 could be remembered not as the end of opportunity, but as the spark that sends Bitcoin into its most powerful chapter yet. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's begin. The year is winding down, but the noise of warning bells is only getting louder. In every major corner of the global economy, the signals are flashing red, telling us that 2026 might not be a gentle correction or a soft landing. It could be the next great crash. To most people, that sounds terrifying. To seasoned investors, it sounds familiar. And if you know how to position yourself, it might even sound like opportunity. Let's begin with the one signal Warren Buffett himself has often pointed to, the so-called Buffett Indicator. It measures the ratio of total stock market value to GDP, and it has historically been one of the most reliable measures of whether equities are overpriced. At moments of fair value, the ratio floats closer to 100% of GDP. At moments of mania, like the dot-com bubble, it soared to 162% before collapsing. At the height of today's market run, that ratio touched 220%. Even after recent pullbacks, it remains close to 200%. That's not just a little overvalued, it's screaming bubble territory. History shows that every time we reach these levels, something eventually snaps. But valuations aren't the only danger. The Federal Reserve's policy is the second red flag, and it's one that directly affects every business and consumer. After years of near-zero interest rates, the Fed has raised borrowing costs to levels not seen in decades. When money was cheap, risk assets such as tech stocks and Bitcoin soared. Now that money is expensive, the opposite dynamic plays out. Businesses struggle to borrow, consumers cut back, and sooner or later, recession follows. The kicker here is that recessions often begin not when the Fed holds rates high, but when it finally starts cutting. By that time, the damage has already been done, and the cuts are too little, too late. History is filled with examples of this policy lag, from the 1970s to the global financial crisis in 2008. And if we zoom out even further, the third warning sign emerges from a century-long perspective. Technical analysts have charted the major resistance trend line running from the 1929 crash through the dot-com bubble, and now, almost 100 years later, we're once again kissing that line. Markets may not be ruled by astrology, but ignoring long-term resistance levels has cost investors dearly before. When these lines are touched, history often repeats itself. That leads us into red flag number 4, the housing market. Adjusted for inflation, US housing is now more unaffordable than it was in 2006, right before the subprime meltdown. Incomes haven't kept pace with home values, mortgage rates are punishingly high, and affordability is near record lows. We all know what happened last time those dynamics lined up, a housing crash that bled into every part of the global economy. And today, signs of stress are already showing. Listings are piling up, mortgage demand has collapsed, and cracks are spreading worldwide. Finally, the fifth warning sign comes from Bitcoin itself. Since its creation, Bitcoin has followed a 4-year boom-bust cycle tied closely to its halving events. 3 years of euphoric rallies, 1 year of crushing declines. The calendar suggests 2026 is the danger year, the period where a major correction could shake out weak hands. And because Bitcoin often leads the broader risk asset cycle, this timing should not be ignored. When you line all 5 red flags together, the conclusion is hard to escape. The probability of a crash in 2026 is rising fast. Yet while that sounds like bad news, history tells us something different. Crashes create the best buying opportunities of a generation. Warren Buffett himself has famously said, "Be fearful when others are greedy, and greedy when others are fearful." He isn't panicking at these warning signs, he's preparing. And that brings us to the most important decision any investor can make heading into next year. Because the question isn't just whether a crash is coming, it's how you should position yourself so you can win no matter what happens. So what do you actually do if you believe a crash is on the horizon? The answer isn't complicated, but it requires discipline. It comes down to asset allocation, the art of dividing your wealth across different buckets: cash, stocks, bonds, commodities, crypto, real estate. How much you put into each is the single most important decision you will ever make as an investor. If you're all in cash, you're safe from a crash, but you miss out on upside if markets keep running. If you're all in risk assets, you capture all the upside, but you also take the full hit when markets collapse. Most investors struggle to find the balance. That's where Warren Buffett once again provides the blueprint. As of late 2025, Berkshire Hathaway sits roughly 50% in investments and 50% in cash or cash equivalents. Half the portfolio is still working to capture gains. The other half is dry powder waiting for opportunities. And that cash isn't just sitting in a vault, it's deployed in short-term government bonds, generating yield while staying immune to the volatility of markets. In a sense, Buffett has built a perfect trap. If markets melt up, he profits from his investments. If markets crash, he profits from his cash because it can be deployed when stocks, real estate, and even Bitcoin are trading at fire sale levels. This is the essence of winning in both scenarios. For regular investors, the lesson is simple but powerful. You don't need to guess exactly when the crash comes. You don't need to predict every Fed meeting or every GDP print. You just need to balance your allocation in a way that protects you from disaster while keeping you exposed to upside. That's what Buffett is doing. And if the world's greatest investor is loading up on cash while trimming stock exposure, it might be a sign worth following. But here's the key point: none of this means we should abandon optimism. In fact, this positioning is what makes optimism possible. If you're prepared for a crash, you don't have to fear it. You can embrace it as the reset button that gives you access to the best opportunities of the cycle. And when it comes to what those opportunities might be, one voice has been getting louder and far more controversial. Andrew Tate isn't known for mincing words, and his take on the housing market ties directly into this bigger story. Because if Buffett is showing us how to survive the crash, Tate is making a bolder claim. The crash itself is already here, and Bitcoin will be the ultimate winner.
I mean, everyone was going on and on about Wall Street and saying how the ETFs and Wall Street's going to blow it to $1 million a coin. And we see all these huge purchases every day. If you go on Twitter, it looks like they're buying Bitcoin nonstop, thousands of coins, and sailors buying it. But the price doesn't go up. And everyone's like, well, why does the price not go to the moon? That's OTC desks, and perhaps there's something else going on behind the scenes. But I would say what's going to really spiral it upwards, what's going to really send it in a tornado to the sky, is the very simple thing that the biggest Ponzi scheme in history has been property. People buy houses not to live in. They buy houses knowing it's going to be worth more later. And for that to happen, you need to wait for the next generation to slave away to buy your house off you for more than you paid. And if you actually look at the property markets, please correct me if I'm wrong, but I believe that Florida has more houses for sale than any point in its history. In London, the property prices dropped by 47% since COVID. There's actually already a huge problem with property prices in the West. And what's the reason for that? Well, it's very simple. In the 1980s, if you were 25 and you managed to save up 100,000, you'd go to the bank, you'd go through credit checks, you'd show you had 100,000, you'd get out a mortgage, you'd put that as a deposit, you'd agree to get raped by the bank for the next 20 years, and you'd buy a house for more than the person who sold it to you bought it for. But now anyone with 100,000, they don't go to the bank and ask for a mortgage, and they don't go to the bank trying to get hold of a property. They just buy Bitcoin and forget. So property prices are struggling, and they have a problem because young people aren't buying them. I'm not sure if it was America or England recently, they said that more houses were sold to people above 70 than below 30 for the first time in history. Only old people still believe in this.
Andrew Tate has never been afraid of controversy, and when it comes to the housing market, his message is as blunt as it gets. Real estate is finished. He says young people are waking up, refusing to sacrifice their lives for overpriced mortgages, endless paperwork, and a dream that no longer makes sense. His tweet on the subject went viral, warning that housing is about to crash hard and that Bitcoin is the obvious replacement. In one of his recent interviews, Tate expanded on this point. He called property the biggest Ponzi scheme in history. People don't buy homes to live in, he argued. They buy them to offload onto the next generation at a higher price, which only works if young people keep signing up for 30 years of debt. But that cycle is breaking. In the 1980s, a 25-year-old with savings would walk into a bank, show proof of income, and take on a mortgage even if it meant 20 years of repayments. Today, a 25-year-old with savings doesn't go to the bank. They don't want to beg for approval, get audited, and agree to pay 11% interest for decades. They simply buy Bitcoin and forget about the rest, and the data backs him up. In Florida, the number of active listings has surged past 180,000, a 32% year-over-year jump and the highest on record. Demand hasn't kept up, leaving sellers competing with each other in a way not seen since before the 2008 housing crash. In London, property prices have collapsed nearly 50% from their pandemic highs, wiping out trillions in value. In New Zealand, cities like Auckland and Wellington have seen home values fall by as much as 30%. Everywhere you look, the same dynamic is playing out. Supply is rising, demand is shrinking, and affordability has been destroyed. Tate's point is simple but powerful. The older generations built wealth by riding real estate bubbles. They bought cheap, watched prices climb, and sold to the next wave of buyers. That playbook only works if young people continue to play along. But they're not. For the first time in history, more homes in the United States are being sold to buyers over the age of 70 than to buyers under 30. And what replaces that model? He believes the answer is Bitcoin. When he was asked what could send the price of Bitcoin to $1 million, he didn't point to ETF inflows, institutional adoption, or Federal Reserve policy. He said the real rocket fuel will come from this generational shift. As younger people come into maturity, they'll be faced with a binary choice: commit to decades of debt in a collapsing housing market, or buy Bitcoin, put it in cold storage, and go live their lives. He's betting they'll choose Bitcoin every time. As shocking as that sounds, the logic isn't far-fetched. A mortgage at today's rates can easily cost a young family hundreds of thousands of dollars in interest over the life of the loan. The process requires endless paperwork, bank scrutiny, and government oversight. By contrast, buying Bitcoin requires nothing more than a wallet and a few clicks. And unlike a home, Bitcoin is liquid, global, and scarce by design. Only 21 million coins will ever exist, and no amount of policy can change that. As housing markets continue to crack, his thesis becomes less about opinion and more about math. If young people aren't willing to buy homes, the foundation of the real estate Ponzi collapses. And when those same young people redirect their savings into Bitcoin, the inflow could dwarf anything ETFs or hedge funds have done so far. What Tate has done is frame the conversation in generational terms. Boomers trusted banks and mortgages. Millennials and Zoomers trust Bitcoin. The shift doesn't need to happen all at once. It just needs to accelerate steadily, year after year. And once the scale tips, there's no going back. The question then is not whether real estate is overpriced. It's whether young people will continue to play the game. The evidence suggests they won't, which means the money is moving elsewhere. The housing market is cracking under its own weight, and Bitcoin is emerging as a replacement vehicle for wealth creation. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Now, let's dive right back in. The traditional real estate narrative was always that housing was safe, you could buy a home, hold it for decades, and know that one day you'd sell it for more than you paid. That assumption worked in an era of falling interest rates, rising wages, and limited supply. But the conditions that supported it no longer exist. Interest rates are high and may stay high longer than anyone expects. Wages have stagnated while home values skyrocketed. And supply is finally surging, not shrinking. For younger generations, that story is dead. They aren't looking at homes as a ticket to middle-class stability. They're looking at them as traps. Why sign up for 30 years of debt in a world where job security is fragile, inflation eats away at every paycheck, and governments tax you at every step? Why tie your future to a market already showing cracks when there is a parallel system built on absolute scarcity and independence? This is where Bitcoin enters the picture not as a speculative trade, but as the new foundation for wealth building. It doesn't require permission from banks, it doesn't tie you to a local market, and it doesn't bleed you with hidden costs like property taxes, insurance, and endless repairs. Bitcoin has no tenants, no maintenance, no mortgage broker. It is pure ownership secured by math and global consensus. Tate's thesis may sound radical to some, but history is full of generational wealth shifts. There was a time when farmland was the primary form of wealth. Then industrial capital became dominant. Then suburban real estate. Each era believed its form of wealth would last forever. Each era was wrong. Bitcoin, with its fixed supply and borderless nature, is positioned to be the next phase. And here is the bullish takeaway. If Tate is right, then the housing crash isn't just a risk to avoid, it is the very trigger that accelerates Bitcoin's adoption curve. Every for sale sign that lingers, every mortgage rejection letter, every frustrated young saver is another nudge toward the orange coin. Crashes don't just destroy wealth because they reallocate it. This time, that reallocation is flowing into Bitcoin. The old world of housing-driven wealth is fading, and the new world of digital capital is rising to take its place. When markets collapse, the first instinct is always the same: run for safety. That usually means cash, short-term bonds, and assets perceived as stable. But history shows that staying in cash forever isn't the winning move. Safety buys you time, not wealth. The real winners are those who know where to redeploy capital when fear peaks. Warren Buffett understands this better than anyone. That's why Berkshire Hathaway is sitting on an enormous cash pile. He isn't hoarding dollars because he loves them. He's hoarding dollars because he knows that when panic sets in, valuations collapse to levels that create once-in-a-lifetime buying opportunities. Cash gives him the option to pounce. But here's where the 2026 setup looks different from previous cycles. In the past, when markets crashed, money flowed back into traditional assets, blue-chip stocks, real estate, and government bonds. This time, those very assets are at the center of the bubble. The Buffett Indicator shows stocks are dangerously overpriced. Housing is flashing red across multiple countries. Bonds, after decades of declining yields, are struggling under the weight of inflation and government debt. So, if all the old safe havens are compromised, where does capital flow after the crash? That is where Bitcoin enters the picture in a way it never has before. For the first time in history, there is a parallel system with global liquidity, deep adoption, and a narrative of absolute scarcity. And unlike real estate or equities, Bitcoin doesn't need a new generation of buyers to bail out the old one. Its value is not built on debt, but on mathematics. Andrew Tate's generational argument fits perfectly into this moment. If younger investors refuse to enter the housing trap, the capital that would have gone into mortgages and down payments has to find another home. If older investors lose faith in bonds and equities, they too will search for assets that can't be inflated or manipulated. The overlap between these two forces is Bitcoin. And let's not forget the elephant in the room, ETFs. While Tate downplays them in favor of the generational story, the flows are real. Billions of dollars are entering through these regulated vehicles, giving institutions and pension funds access to Bitcoin in a way they never had before. Combined with the cultural shift among young people, this sets up a two-front surge of capital that no crash can contain. That's why the coming crisis doesn't need to be feared. It needs to be prepared for. Cash gives you protection. Bitcoin gives you the upside. Put the two together, and the crash of 2026 transforms from a threat into an opportunity. As Warren Buffett positions himself for safety and Andrew Tate frames the collapse of housing as inevitable, the conclusion becomes clearer by the day. The old playbook is breaking down. The new one is being written in real time. The crash won't be the end. It will be the beginning of something much bigger. Think about what happens when an entire generation rejects the wealth model that came before it. Farmers once believed land was the ultimate store of value. Industrialists thought factories were unshakable. The suburban boom convinced millions that houses were the foundation of prosperity. Each cycle ended when the math stopped working. Each transition created pain, but it also created new opportunities for those willing to adapt. The crash of 2026 could be remembered the same way. Stocks, housing, and bonds may all face resets, but Bitcoin offers something different. It is not tied to any government or banking system. It is not dependent on a future buyer paying more. It is not a Ponzi scheme built on leverage. It is digital capital with a fixed supply and global demand. This is why the crash, as devastating as it may look on the surface, should be seen as the ultimate reset button. It flushes out excesses, reprices bloated assets, and reminds investors that nothing grows forever. But it also accelerates the search for alternatives, and Bitcoin is positioned to catch that wave. We're already seeing it play out. In Florida, listings are climbing faster than buyers can keep up. In London, nearly half of home values have been wiped out. In New Zealand, entire cities have seen declines that would have been unthinkable just a few years ago. These are not isolated blips. They are the signals of a larger breakdown, and every young person watching those headlines is quietly asking themselves a question: why would I tie my future to that? Meanwhile, Bitcoin continues to expand. More wallets are being created. More businesses are integrating payments. More governments are exploring Bitcoin reserves. And through ETFs, more institutions are buying than ever before. While housing struggles to find new buyers, Bitcoin finds them every single day. This is why the bullish case remains unshaken. Crashes do not kill Bitcoin, they validate it. Every time traditional assets fail, Bitcoin stands taller. Every time governments print to bail out the system, Bitcoin's scarcity shines brighter. Every time a young person walks away from a mortgage and into cold storage, the adoption curve steepens. The strategy is simple: stay protected, stay liquid, stay ready. And when the dust settles, make sure you are holding the asset that doesn't just survive the crash, but thrives because of it. Because the great crash of 2026 will not mark the end of opportunity. It will mark the beginning of Bitcoin's true breakout. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.